Hi everyone, this is Simon Street with Denver Business Coach, and today I wanted to talk to you a little bit about the conversation we've been in, which is taking this as an opportunity to rebuild a company that is not necessarily exactly the same than the company that it was before the pandemic. And we speak to a lot of business owners, and more often than not, the conversation really is, you know what, even before this pandemic came, things weren't all that great. And there were a lot of things that, in hindsight, or if I had an opportunity to do it all over again, I would do differently. And what I wanted to, I think, share with you a little bit about is the conversation around where do you go to find out about what you would do differently? Hindsight is only as good as to the clarity that you have right now. And I think there's still a lot of business owners that even at this point, they have a sense of certain things that maybe didn't go as well as they wanted, or where their business had weaknesses. But where we really want to come from and educate is, how do you really build a business that is set up to succeed, that is valuable, that is sellable, that is a business that you own and run, and not vice versa. And so I thought this is a great time to really take a few minutes and talk about what makes a business a really good business. And if you think about selling your business at some point, rather than just closing it down, but actually having a valuable asset, what are the things that a potential buyer are looking for in your business to see value in it? So what I'd like to do today is just go briefly over what we call the 8 value drivers, which are certain perspectives that business owners that are looking to acquire a company look at and or look through, and basically make an assessment whether your business is either doing well in these areas or not doing well. And if your business is doing well, it drives up the value. If your business is not doing well, you're losing value. So what I'd like to do is actually share with you the screen right now and go briefly over what the 8 value drivers actually are. So when we work with clients, one of the ways that we focus on, or one of the things that we do very early on, is take a value builder questionnaire. And as a result of that, the client filling out that questionnaire, we get a scorecard. What you're seeing here is the overview of the scorecard. We actually generate a 27-page report that goes into great detail in each of these areas. But we get an overview, we get an overall score, and we know that the higher the score, the higher your valuation is, and the higher the sellability of your business is. So our goal ultimately is get you from where you are, and in each of these areas improve, so that ultimately your overall score is going up. So the first area that we're focusing on, I think, is the financial performance. And of course, this one is, I think, fairly simple to understand. The more profitable your company is, the higher the revenue and the discretionary earnings, the higher the price you're going to get for your company. There is a second aspect, though, to it, which is really how defendable are your numbers. So this is really when a buyer is looking at your company, there's this dynamic going on between you want the most out of your company, the value, and the buyer wants to pay you the least amount of money. So as a seller, you're going to have to have really good financial records and be able to defend the numbers that you're presenting in the sales process. And that really comes through having outside bookkeeping, having very clear records, maybe having done an audit before, so that you can really defend those numbers. But obviously the primary aspect here is the more profitable your company, the higher of a multiple and the higher of an offer you will get. The second aspect is the growth potential of your company. So obviously, as an owner of the business that's looking to sell, you want to get money for everything that the business has accomplished. Maybe you have won awards, maybe you have gotten a certain market share, maybe you have accolades, you have a reputation, and that is worth something. But what you have to understand is that for you as a seller, your journey and the business journey is going to end. Whereas for the buyer, the journey is just about to start. So while you're selling everything that the company has accomplished, a buyer is buying the future revenue and profit streams that they anticipate they will get from the purchase. So what you will need to do, and ideally what you're able to present to the buyer, is that your company has a lot of growth potential and that you can either go into new markets, or you can offer additional services or products, or have opportunities to cross-sell, upsell, downsell. So really a buyer is going to look at what is the growth potential of your company, and the bigger the growth potential, again, the higher of a multiple you can negotiate. The third driver is the Switzerland structure. And the Switzerland structure is really based on the concept of neutrality, which is all about how dependent is your business either on certain customers, on certain employees, or certain vendors. So let's say, as it relates to customers, if you have let's say you have $1 million of revenue, but 300,000 of that is coming from one customer. So the way that a buyer would look at that is, the moment you lose that one customer, all of a sudden you lose 30% of your business. So to the buyer, that is a high risk, and will essentially discount the value for it. The same thing is true for the vendor. If your entire business concept is based on having a certain relationship with one vendor, and something would happen to that and you would not have a business model anymore, obviously that would reduce the value of your company significantly. So as an owner that's looking to build a sellable business, you want to get as diversified as you can in those three areas: customers, employees, and vendors. So that, for example, what we're looking for customers, you don't want any more than 15% of your revenue coming from one client, for example. So the goal here is to diversify, and the more diversified you are, the more you can defend the value of your company. The next driver is what we call the valuation teeter-totter, and that's really centered around a system or a concept, which is, as a buyer that's looking to buy your company, they essentially have to write two checks: one to you as the seller, to buy the company, and then the second is to continue to operate the company. So if you are, for example, if your company is requiring a lot of operational capital, the buyer has less money available to actually pay you, because they also have to put money into the operations of the business before the business starts turning a profit. But if you have a business that is cash flow positive right from the get-go, for example, people pay you up front before you even do any of the services or produce the products, now all of a sudden the buyer doesn't have to generate extra money for operational expenses, and can therefore pay you a higher premium for your company. The next driver is what we call the hierarchy of recurring revenue. That is really about what percentage of the revenue that your business is generating is based on recurring revenue. And that's really been one of the drivers that a lot of buyers in the last few years are looking at, because recurring revenue has a lot of benefits. You can better forecast that revenue, you can better plan for that revenue, you can operate a more lean and efficient business model, because you already know that the type of services or products that you're going to provide, and can plan for that. And there's also more security in terms of like long-term commitment from your customers. So if all your business is coming from, let's say you have $1 million company, and for one company, the majority is coming from recurring revenue, that valuation is going to be significantly higher than a $1 million company that has all revenue coming in one-off transactions. So the next driver is what we call the monopoly control. And this really is all about how differentiated are you in the marketplace? How much competition do you have? The higher your monopoly control is, the more you are in control of pricing. So the higher your monopoly control, the less of a commodity your product or a service is, which will then allow you to control your pricing better, which will then allow you to operate on higher profit margins, which will then allow you to build a stronger brand, put the money back into the business. And it has really this really beautiful effect on a business to continue to grow very nicely, versus if you're a commodity and not very differentiated, you're going to find yourself in price wars. You're going to find yourself operating on very low profit margin, and just the flexibility in terms of growth is going to be significantly lower. So the next driver that we're looking at is the customer satisfaction. And customer satisfaction, the tool that we're using here is a tool that's called the Net Promoter Score. And the Net Promoter Score, what it does, it's essentially measuring and benchmarking your performance on the likelihood that your customers are going to recommend you. It's based on the question that you've been asked a million times, which is on a scale from 1 to 10, how likely are you to refer friends or colleagues to us, to our company? And then anything that's rated as a 10 or a 9 is what's called a promoter. 8 and 7 are neutrals, and 6 and below are detractors. And then essentially what you do is you subtract the detractors from the promoters, and whatever is left there on a percentage wise is going to be your Net Promoter Score. Net Promoter Score, what it ultimately tells a buyer is that you have a great product, that you have a great brand, that you have a customer base that's willing to continue to engage with you. The higher the Net Promoter Score, the more likely it is and the easier it is for a new buyer to continue to grow based on your customer base. So really, if you're starting to look to sell your company, you want to start implementing the Net Promoter Score as a KPI in your business. And then the last driver is the hub and spoke, which is essentially all about how much is the business dependent on you as an owner. And again, the more independent the company is from you as an owner, the higher the score, the more dependent, the lower the score. And obviously, I think we all understand the benefit of it. People buying your company, they don't want to buy a job. They don't want to buy the predicament that you might be in right now, which is you're wearing 15 hats and barely get some night to sleep or have time with the family. Ideally, you've really built a company that can run without you, that has a management team in place, and that is not dependent on you and the owner. So, for example, if you're thinking about what would your company look like if you would take a 3-month vacation, and then you would come back, and if you can say that your company is fairly operational and the management team knows what they're supposed to do, and things can continue the way that they should, then you're fairly independent. If you're saying this is going to ruin my company and there's no way I can leave for 3 months, then you have work to do here. And again, from a buyer's perspective, that will reduce the value that you can get for your company. So that's a quick summary of the 8 drivers that we use to evaluate a business. And of course, we go into much more depth with it and gather more data. But this is just to give you a sense when you're now looking at how do I restructure my business? What is really important? Which areas do I need to be focused on more? We really suggest that you look at these 8 different areas and start looking where are you at in each of these areas, and then what do you need to do, or what are some actions that you can do to increase your score. And if you have any questions about how to do that, if you would like to take the Value Builder assessment and get your score, you can visit our website at denverbusinesscoach.com. And I think we're also going to include a link in the description of that video as well. All right. Thank you for your time. I'm very much looking forward to hearing from you. If you have any thoughts or comments on this, we're always happy to hear and look forward to a productive conversation. Thank you.